Uche, let me ask you very quickly. What's your take on this development from the business side of things?
Well, I think there was too many ambiguity with this suspension. We need to really wait and see exactly what they mean. Is it that Twitter operations will really just stop or have its halting in the country, basically, in that people can access or people can tweet, or maybe from a business point of view, Twitter in itself would not have an operation base, which they don't have really. I think there was a big round of news going on a couple of months back where Twitter was setting up the West African office in Ghana. So there was too many ambiguity with these things, and so we really need to sit back and understand the landscape in which they are trying to implement such, should I say, news or decision, Boston.
Yes, it's a developing story, by the way, and I'm sure quite a whole lot of folks are looking at the business and investments implications of this decision to suspend Twitter operations in Nigeria by the Nigerian authorities. So let's leave it there for tonight on that. Let's get the biggest story, which is because on June 5th, 2014, 2 days after taking office as the new central bank governor, Godwin Emefiele held a press briefing where he outlined his vision for the financial regulator and the broader economy. The new, fresh central bank chief then says he looked forward to creating a central bank that suspends its energies on building a resilient financial system that can serve the growth and development needs of our beloved country of Nigeria, end of quote. Now, yesterday, June the 3rd, Godwin Emefiele clocked exactly 7 years in office. Today, we will review his policies and practices over the period, while my guests will also provide their future-forward outlook on central banking under Godwin Emefiele. So let's get started. My guests are Professor Ken Ife, a development economist at our Abuja studios, and here in Lagos, of course, Emefiele's, managing partner at Howard Minis Asset Management. Gentlemen, great to have you on the show tonight.
Thank you, Boston. Thank you for having me.
Well, thank you very much for inviting me.
Thank you very much, Professor Ken Ife. Let's start with you. Would you say the central bank governor had been somewhat consistent over the past 7 years, considering what he outlined as his broad visions about 2 days after he took office in 2014? We'll put a bit of that on the screen, but I just want to ask you that question. Do you think he's been consistent when he spoke about his vision?
I think he is. Despite all the odds. In fact, when he came into office, he received a baptism of fire. And you can only understand that when you look at the context, the landscape, when he actually came into office. We had the aftermath of the 2009 financial crisis, in which the government responded by creating AMCON that ended up with 6 trillion, of which we've only recovered 1 trillion. But bear in mind also that at that moment we had foreign reserve around $62 billion and about 22 billion in excess crude accounts. So we had the money to spend. But of course, when Emefiele entered with all his promises, a lot of it started happening, but some had to wait because he entered into a very, very difficult, challenging time. He just entered, and within a few months, he witnessed a major international crisis, which, as you know, was a heavy drop, 60% on the price of crude. And it's a long story, but what really happened. But he came out from this, and the second term vision was much the same as the first one, but except that he was moving the country forward. Yeah. And building on what he has achieved in the first term.
Yes, we'll talk about that. We're trying to find out, Professor Ken, when we look at his broad vision, the kind of central banking business that he says he wants to do. Let me ask Uche, is what he thinks about this. He spoke about, Emefiele spoke about delivering price and financial system stability and promoting sustainable economic development. It looks like all-inclusive.
Right, Boston, so I think for us, right, if we want to be fair and holistic in terms of his policies implementation, we can say he has done fairly well.
Well, what I mean in terms of his vision first, let's leave that later. About his vision, what we see today, was he encapsulated in that vision 7 years ago?
Well, Boston, basically, that's what I'm trying to say. We really need to look at the horizon in itself, right? So if we take from 2014 to 2019, he was on the right course. Now, are we going to take away the uncharted variable with the pandemic of 2020, which has literally taking all of these policies implementation by another 2-3 years backwards? So if we want to look at it in real terms, we can say, well, he has not really gotten to that point. But we can look at the first sector or first session between 2014 and 2019 and the course in which he was trying to achieve this macroeconomic stability, financial inclusion, and other ways in terms of stimulating growth in the economy at large. And it was really looking good. But when we got to 2020, where we had this pandemic that hit the world in an unprecedented way, we can say, well, we have fallen short, and we are back to that point whereby we're trying to face, we're looking to face some sort of economic crisis. If we look at the point where he came in at 2014 and what he did at the point where 2019 between the exchange rate, you could see some sort of progress, really. We had a stable exchange rate at that 360 level, but right now, we are back to not of 500, really, if we want to look at parallel market rates in terms of how these exchange rates are being priced in. So for me, it is a two-way horizon. We need to break this down. From 2014 to 2019, yes, it was doing all right.
Yes, we're going to break it all down into that. I'm looking at that particular part of his vision where he wrote, and I'm going to put it back there for everyone. It says, price stability can rarely be adjudged a goal in itself, except cast against ultimate objective in the quality of life. We'll talk about that when we return.
Well, remember also, part of that vision was that he was going to make central bank a people-focused central bank. And at the same time, he was committed to making sure that there is a massive domestic finance intervention on structural areas in the economy. And we know that agriculture, industries, and all those structural areas, because he knew that ultimately these are the areas that will affect price stability, of course, inflation. So I can connect that to the statement that he made, because if you look at price stability, yes, generally price money supply affects it, but it's domestic money supply and also forex money supply. And then forex does the biggest damage to price stability in the country, because we have little control over those because of our monocultural economy. So, but to build a resilient economy, a well-diversified economy that also could diversify the export revenue base is all part of what he's trying to say. And that ultimately, these are going to affect our targeting on price stability. That's how I understand that.
Yes, so he said further in that 2014 that we shall pursue a gradual reductions in interest rates. The bank would also, under monetary policy, by the way, we would also begin to include unemployment rate as one of the key variables considered for monetary policy. So if you take this further, Professor, just this question to you again. Do you think this, this vision had been consistent with the state of the Nigerian economy, unemployment being one key focus? This is tying unemployment to monetary policy.
Absolutely. You know, the reason is this. Prior to his coming, there was an obsession on inflation targeting, and to the point that we seem to sacrifice growth and productivity, which is also responsible for high unemployment. So he brought them together. In fact, don't forget again that he actually targeted the very high treasury bill rates that were nearly 18%. And he succeeded in bringing it down because that was crowding out investment to the private sector. He brought it down to even less than 1%, as you saw. But there were many other means that he used, including, of course, exiting the domestic private sector from open market operations and many other measures. So he eventually got that down. And then he targeted resources to key areas like agriculture and the manufacturing sector, even creative and cultural, all the areas that provide the jobs and can sustain the employment. So he was right in shifting the emphasis from inflation targeting of previous regime to a much more people-friendly and people-focused and employment targeted and the resource going to tackle the structural issues in our employment, in our industry configuration, and of course, give more opportunities for people to get jobs and create more diffusion and access to microcredits and finance. And these are some of the ways you can measure him. There were challenges, without a doubt, on price stability. Because as I said, most of the issues affecting the price stability were exogenous to our economy, ranging from oil prices, shale oil at that time, and then all the other crises, turbulence between America and China, all of them were affecting the supply of foreign currency from our crude. But with the resources that he has available, he really targeted the weakest points in our economy to achieve greater diversification and achieve as much employment as possible.
Professor Ife, one of the very most naughty part of this conversation of our economy, the central bank governor, and I'm asking Uchenna this, himself admitted in 2014, 2 days when he took office, and he says on exchange rate, he says there is no doubt that reducing the interest rate and maintaining the exchange rate are very daunting twin goals. Uchenna, exchange rate, interest rate. So coming straight from commercial banking, he knew that these were, according to him, very daunting dilemma.
Yeah, and for him, basically, I think he was just basically trying to say that having to pin down these macroeconomic indicators basically puts the economy in a should I say, good place, a stimulating place in terms of growth. We are a country that is severely dependent on importing a lot of, should I say, goods and services, and also our dependence also in oil pricing as is a key, should I say, source of exchange into the country. And that in itself, if you see what he has just put out, is saying that if we could cap the exchange rate at the same time cap the interest rate in some sort of comfortable horizon, and that way it increases the healthiness of the economy. And I get his point, really, because the way we're structured from an economic landscape is putting us in a place whereby we are dealing with a double-edged sword in terms of a double whammy effect, if I should use those words, in terms of how our economy is being propelled, really. So I get his point. He understood the fundamentals that can be adjusted for optimism, and basically that was why he put out that statement and set up policies to implement along that horizon.
Well, the twin, the flip side of the exchange rate, interest rate, Professor Ken Ife, has to do with the financial system stability and banking supervision under Emefiele. Do you think he did well? How do you think that? He said there'll be a zero-tolerance policy. Do you think he was able to do that?
Yeah, I think he did extremely well on that front, bearing in mind that when he came in at the back of all kinds of uproar in the financial systems. The non-performing loans were even as much as 15 to 20% for many of the banks. The prudential guideline is 5%. Then the capital adequacy ratio was so low for most of the banks. Now it's about 15%, the guideline. And so within 2 years, he has actually started bringing them down and then narrowing the gap. Even the liquidity, he was improving liquidity in the banking sector. And many of these he achieved in his first. And in fact, he got the banks in a very stable footing before he could move to push for more access to finance. In other words, remember that in 2008, when IFC did the survey, only 7.5% of the banks' lending was going to private MSMEs. And in 2013, it dropped to 0.4%. So Emefiele was prepared to fight his way to push more credit to the private sector. But first of all, he had to get the banks stricter risk-based supervision to get them stronger before that push. And when he did that, he now focused on raising the loan-to-deposit ratio, improving so he pushed over 5 trillion into the private sector. So, but the banks had to be strong. So he got that first and then began to roll out his measures on pushing more credit to the private sector. And of course, reducing the yield on treasury bills was also part of it, because you are freeing you are removing the crowding out that was of investment that was supposed to be going to the private sector. So all of this we are coming on nicely before the second term.
Okay, I want you to stand by. Let's get to one of the brick and mortar areas in which the central bank chief had gotten a whole lot of hard knocks, which has to do with development finance. But he did say at the beginning of his tenure in 2014, he says, but we were particularly worrisome, the rate of youth unemployment way back in 2014, with an annual addition of 1.8 million Nigerians to the labor pool. The central bank cannot afford to sit idly by and concentrate on price and monetary stability. So he went on further to say the central bank will target some productive sectors, impose the monetary and performance, challenging credit, a review of the central bank development finance program. That was all he said on June the 5th, 2014. 7 years down the line. Professor Ife, let me start with you. How much do you think it has been achieved, they have been able to achieve using monetary policy tools and unconventional intervention measures in development finance?
He has achieved a lot. You know, it's unbelievable. We'll go through a list. Now, what I would say by way of mandate is the core mandate of the central bank is price stability and financial system stability. But there are secondary mandates. The secondary mandates that to promote sustainable economic development. And then, of course, you also know that is the lender of last resort. So in that respect, they have to intervene if there are market failures, because we are running a market economy. So there are substantial market failure in access to finance to MSMEs. There are various industries where the banks will not lend. They won't tell you. For example, agriculture. He had to set up NISA PLC to go and give them $500 million to move into de-risk agriculture. And so that's the beginning. So he was very right in intervening. And then also, when you look at, we were already beginning to approach the limit of monetary policy in dealing with the challenges of price stability. And you look, for example, we can understand how the domestic credit could affect inflation. But how about the fact that we have a monocultural economy that depends, 90% of its forex revenue is coming from oil. And so we are so exposed to that exogenous factor and that turbulence. But secondly, look at the population. The population, about 40% are not banked. They don't have bank accounts. Over half of Nigeria, over 100 million people are poor. And then 80 million are below poverty line. So when you are beginning to put too much emphasis on the use of monetary instruments to control price stability, the banks are not lending. So where is the money going to? They are not lending. Half of the people are poor. There's 80 million don't have bank account. So where would monetary policy alone take you in fighting price stability? Then most of the inflation that you have, which is price stability issue, are too structural. They're structural because you could see it in inflation figures where the core index is usually around 12%, but the agriculture the food basket index and the actual farm produce is nearly 23%. That gap of 10% tells you that you have to watch what is going on with the farm produce. And then you can correlate that with so many other things going on in the economy. The fact that Nigeria is feeding 300 million, not 200, when you add all the Francophone countries surrounding us, Chad, Niger, Mali, we are feeding all this population. And there's nothing you can do about it because they are protected by ECOWAS Treaty of free movement of food. You are not being paid those food. We are using Naira to settle. They are not using dollar to settle. So, you know, we have serious issues. And then you have conflict in all the 6 geopolitical zones that has shrunk the agroecological footprint. And even within that shrinkage and massive displacement of people in IDP, we still were able to post 3.8% growth in agricultural GDP. That in the fourth quarter. So it is a big battle, and that can only be possible because of the massive scale of intervention in the agricultural space. And then, of course, the mineral. He's now gone for minerals, and then you could see that gold, they are purchasing gold, refining and bringing it, so that our dependence on a dollar as a gold reserve will all shift. So we begin to have more gold in the mix. and solid minerals. So there are many areas in the manufacturing sector. You know why manufacturing is so important? Unfortunately, 80% of our manufacturing capacity in Nigeria is dependent on imported material or spare parts. So you have to change that over time, but not immediately. So we have to plan to restructure that. But because we are dependent on that, then we have to continue to draw our foreign exchange.
But Professor Ife, let me ask Uchenna something which is a corollary to that, which has to do with SMEs funding. So Uche, this was what the Central Bank Governor said in 2014. He says funding for SMEs in Nigeria has largely been viewed from a social development perspective, with the goal to reduce poverty through job and wealth creation. Going forward, we propose a business approach to funding SMEs. So he says the central bank will revisit the goals and implementation of intervention programs in those sectors. So funding SMEs seem to have taken some chunk of effects from the central bank over the last 7 years. Do you agree?
Yes, I totally agree, also. And see, the situation here is, what other options does he have, really? And that's what we really need to ask ourselves. I think it was a smart move, albeit unconventional, because we're in a place whereby we are dangerously reliant on oil sales. And with this plan of his, with this policy's implementation, trying to directly bolster growth in this other real sector, what that has done is it has created jobs by proxy indirectly, and also try to create and stimulate growth in that non-oil aspect of the economy, really. And that is really key for us as a country, because we are in a place whereby we are entirely dependent on exogenous factors, as Prof has rightly mentioned. And there are too many global variables that, as a country, we have to now start depending on, while we are dealing with our own inherent variables. So I think it has been very, very effective in its plan to apply that route. Yes, it's very unconventional, very unorthodox, given what central banks' monetary policies and mandates are. But we are in a place of should I say, near crisis, really, when it comes to how to stimulate growth from both monetary policies, conventional monetary policies, and unconventional monetary policies, also.
Yes. So here we are with the central bank governor. After his first term, he got screened by called clear by the Senate for a second term. Then he spoke and disclosed his, what he called his 5-year policy, which was 2019, 2024. And he says, as in the case with most plans, although most of the goals we set were achieved, I will be the first to admit that everything did not happen as contemplated. I think it is fair to state that our task of building a stronger economy is far from complete. The pace of GDP growth remains fragile and is below the rate of our annual population growth at 2.7%. Professor Ken, this is a clear admission that by the central bank chief in 2019 that all hadn't really been well, that a whole lot of headwinds.
Well, I expect a honest man to say exactly what he said, to be the first to say, I haven't got it 100% right, and there are more areas for challenge. And to be honest with you, what you've just mentioned are moving targets. The GDP is a moving target, inflation, everything is a moving target, and they can change, and we don't have very much control over some of the variables that impact on our economy. So it is a work in progress. But I tell you this, based on the last question you asked, the way he has gone about systematically driving credit to the private sector in a very formalized way is one. I'm going to deal with intervention. But if you notice that he has used loan-to-deposit ratio to reason it so that the banks will have no choice, will have little window to lend other than to go and lend to the private sector. He also moved the differentiated cash reserve ratio by asking them to come and take your cash reserve is over 4 trillion in the vault. Come and take this money that earns you 0 interest and go and lend to the private sector as long as it's medium term, 7 years, 9% interest rate. So he's using them to drive it, because in the end of the day, he has done about 4 million farmers have got money for the Anchor Borrowers program. That is 4 million farmers. There are 44 million MSMEs in Nigeria. He cannot use intervention fund to reach all the 44 million. It is still, in the end of the day, going to be these people going to the market to borrow money. So that is why he's shifting the system to make sure that they still go back to lend to the people. So all the intervention that he's doing is just to demonstrate that these things can work, the structures are correct, and then they will eventually have to go to the market to borrow.
Uche, what is your future forward outlook from a financial markets investor and trader and analyst point of view on the road Godwin Emefiele has traveled so far?
Well, I think is picking up the rumbles basically right now. I think his policies laid down for 2019 to 2024. I think we're literally just picking up at the moment in terms of macroeconomic stability, price stability, and also the targeted funding to exchange rate stability. And all these things are not they're not overnight issues, really. You need to really lay down the structural work to encourage such or stimulate such growth in the economy, really. But I could see what he's doing, especially when it comes to the FX space and how it's trying to keep and seal off those leakages that's causing significant stress on the market or on the naira. But we're also looking at the exogenous factors, really. Oil prices already trading at north of $70 per barrel, and that's really looking good from that point of view, really, in terms of our oil sales and revenue from that space. And also with this, should I say, managed harmonization of FX float, really, there is some sort of encouragement from the FPIs and FDIs, which I think is looking to do for a while now, and that in itself can encourage inflow of USD. We also saw the policy of the dollar remittance for 5 naira.
So Uche, here is Godwin Emefiele sounding the way he did in 2019. Then in first quarter last year, 2020, we had a global virus pandemic. So you think his job had been made a little bit more tougher or easier by the pandemic moving forward?
No, I think it has made it really tougher, and it's not just him; it's all central banks in the world. This was an uncharted, should I say, event, and everybody was hit spontaneously, really. So, and that's what I was trying to say. Where we look at what he was set to do, this has taken him another couple of quarters backwards. But it is the important thing to have those visions and ambitions really set and laid out and continue to implement them. But I think his activity and aggression in terms of lending to that real sector, and also forcing the commercial banks, the deposit banks, to continue to bolster growth in that regards. I think that has been quite effective, and really that's what Nigeria really needs to be looking at. Yep. The shift away from dependence on oil sales.
In just 1 minute, Professor Ken Ife, can you give me your future forward outlook? Whether you think his 5-year policy of the central bank governor needs to change or be tweaked as we move forward?
I think he needs to consolidate what he has started, because the long-term future of our economy, in terms of achieving the diversification that will bring more resilience to our economy, in terms of maintaining price stability, all of them depend on the extent to which resources can hit the private sector, especially the real sector. And he has laid solid foundation. He has improved on them, on the infrastructure, payment infrastructure. He has brought in many things like book credit bureau, different movable asset register. All of those are moving in the direction of easing credit to the private sector, and that is where you will get the challenges.
Thank you very much.
You will address the challenges facing the economy in the long term.
Gentlemen, we thank you so much for making the time on the show this evening. Enjoy your weekend and see you some other time. Professor Ken Ife, development economist, and Uche Namini's global market strategist and manager partner at Howard Minister Asset Management. We're right back.